Most people think they own a diversified portfolio. They imagine something spread out, balanced, protected from any single failure, a wide safety net. But there's a quiet reality sitting underneath millions of accounts that almost nobody takes the time to inspect. By the time the next major market cycle fully plays out, a huge number of investors are going to realize that what they believed was balance was actually concentration hiding in plain sight. Not because they made reckless decisions, but because they followed instructions that were never fully explained. There's a structural pattern that has repeated itself across centuries. Different countries, different assets, different narratives, but the same underlying mechanics. A small group of assets becomes dominant. Money flows into them because they are performing well. Their performance is then used as proof that they deserve even more money. And eventually, the weight becomes so uneven that when pressure hits, the entire system bends around those few points. That's where things break. And right now, that exact structure exists again, quietly, mathematically, and almost perfectly disguised. Not in some obscure corner of finance, but in the most recommended investment strategy on Earth. The one people trust the most. The one that requires the least thinking. The one that feels the safest. What makes this different from past cycles isn't just the concentration, it's timing. There is a very specific window forming where multiple forces are lining up at once: valuation pressure, interest rate reality, and expectation versus delivery. Individually, none of them guarantee anything. Together, they create a stress environment. And most people holding portfolios today have no idea how exposed they are to it. Before we get into what that means, there's something you need to understand first. Not theory, not predictions, but a pattern that has already played out multiple times. Because once you see it clearly, you stop thinking in terms of "this time is different" and start recognizing the shape of what's actually happening. Early 18th century, a nation buried in debt. Years of spending, war, and financial mismanagement had pushed things to a point where traditional solutions weren't enough anymore. The system needed something bigger, something new. That's when an idea entered the picture. A new way to handle money, a new way to assign value, and more importantly, a new story people could believe in. A company was formed around massive future potential. Not current output, not proven income, but the promise of what could exist. The narrative was powerful. Resources, expansion, opportunity beyond imagination. Investors rushed in. Prices rose quickly, then faster, then uncontrollably. And as prices climbed, something subtle but extremely important happened. People stopped asking what the asset was actually worth, and started assuming the price itself was the proof. If it's going up this much, it must be valuable. If everyone is buying it, it must be right. If the smartest people are involved, it must be safe. Money flowed in not because of fundamentals, but because of momentum. And momentum fed itself. Until one simple question broke everything. Can value be converted into something real? When enough people asked that at the same time, the system didn't have an answer. Liquidity disappeared, confidence cracked, and what looked like unstoppable growth collapsed into almost nothing. The people who entered early walked away with enormous gains. The majority, the ones who trusted the structure, absorbed the loss. The system didn't fail suddenly. It revealed what it had been all along. Now move forward. Different country, different era, same pattern. A group of companies becomes known as untouchable. Not just good, not just profitable, but permanent. The idea spreads that these are the kinds of businesses you don't need to think about. You just buy them, and you hold them forever. Valuation stops mattering, because quality becomes the justification for any price. Investors pile in, institutions follow, prices stretch further, and the higher they go, the more confident everyone becomes. Until conditions shift. Not dramatically at first, just enough. Growth slows, costs rise, expectations adjust, and suddenly, assets priced for perfection are forced to behave like normal businesses again. That adjustment isn't gentle. Because when something is priced too high, it doesn't need a disaster to fall. It just needs reality. And reality doesn't negotiate with expectations. Prices drop, then drop more, Not because the companies disappear, but because the price people paid assumed something that didn't happen. And for many investors, recovery doesn't come quickly. In some cases, it doesn't come at all within the time frame they needed. Now, bring it to today. Most people don't pick individual stocks. They don't analyze companies. They don't build portfolios from scratch. They buy funds. Broad, simple, widely recommended funds. And the logic makes sense on the surface. If you own hundreds of companies, you're protected. If one fails, the others carry the weight. It feels stable. But here's the part almost nobody looks at. Not all companies inside those funds are treated equally. The structure automatically gives more weight to the ones that have already grown the most, which means every new dollar you invest is disproportionately allocated toward the largest, most expensive parts of the system. You are not evenly diversified, you are increasingly concentrated. And the more successful those top companies become, the more dominant they get inside your portfolio, without you ever making an active decision. Over time, this creates something that looks balanced on paper, but behaves like a focused bet. A handful of companies quietly start carrying a massive percentage of total exposure. And because they've been performing well, nobody questions it. In fact, their performance becomes the reason people feel safe. But that safety is conditional. It depends on continued growth, continued optimism, continued delivery. And when expectations are high, even small disappointments matter. There's another layer to this that almost nobody talks about. Not because it's hidden, but because it's uncomfortable. It challenges the idea that long-term investing always works the same way for everyone. The concept is simple. Returns don't just depend on how much the market grows, they depend on when that growth happens. Two people can invest the same amount of money, earn the same average return, and end up in completely different financial positions, because the sequence of gains and losses matters. If strong returns come early, losses later hurt more. If losses come early, recovery has time to work. Timing doesn't just affect traders. It affects long-term investors in ways that are rarely explained, especially for people approaching the point where they need to start using their money instead of growing it. Because at that stage, a downturn isn't just temporary, it can permanently change outcomes. Not because the market failed, but because the timeline didn't match the recovery. Imagine someone who has done everything right: consistent investing, patience during downturns, no emotional decisions, years of discipline. From the outside, everything looks perfect, but underneath, their portfolio has slowly shifted. More weight moving toward the biggest names, more exposure building without awareness, more dependency forming on a small group of outcomes continuing exactly as expected. They didn't choose that. It happened automatically. And unless they take the time to look inside, they'll never see it, until something forces them to. The people who navigate these moments successfully are not necessarily smarter. They don't predict crashes perfectly. They don't time markets with precision. They do something much simpler. They understand what they actually own, and they build flexibility into their position. Because when conditions change, the difference between staying in the game and being forced out isn't intelligence, it's preparation. If you have options, you can wait. If you don't, you react. And reactions under pressure rarely lead to good outcomes. There's a way to think about this that makes it much clearer. Not as a single portfolio, but as layers. One part exists purely for stability. One part exists to generate ongoing support. And one part exists for growth. Each has a different purpose. Each behaves differently under stress. And when they're separated properly, the entire system becomes more resilient. Because you're no longer relying on one structure to do everything. The problem today isn't that people aren't investing, it's that they don't know the shape of their exposure. They see the label, they trust the system, they assume diversification. But assumptions don't protect portfolios. Structure does. And right now, the structure most people are relying on has shifted more than they realize. There's a moment that happens for almost every investor at some point. It doesn't happen during a crash. It doesn't happen when things are obviously going wrong. It happens quietly, usually on a normal day. You open your account, scroll through your holdings, and for the first time, you actually look, not at the total number, not at the performance chart, but at what's inside. and something feels off. Not because anything is collapsing, but because things look repetitive. The same names appear again and again across different funds, different accounts, different strategies. At first, it doesn't seem like a big deal. Those companies are strong. They've earned their position. They've delivered results. So naturally, they show up everywhere. But when you take a step back, a different picture starts to form. You realize you don't own hundreds of independent bets. You own variations of the same one, packaged differently, labeled differently, but structurally similar. And that realization changes the way you see everything else. To understand why this happens, you have to look at the mechanism behind it. Not the branding, not the marketing, the math. Most broad market funds are built using a system that allocates weight based on size. The larger a company becomes, the more influence it has, not just in the market, but in your portfolio. That means success creates momentum, and momentum creates even more allocation. It's a loop. A company grows, its share price increases, its weight in the index rises. Every new dollar entering that index flows more heavily toward it, which can push the price even higher, which increases its weight again. This process doesn't require a decision from you. It doesn't ask for your approval. It just happens, continuously, quietly. And over long periods of time, it reshapes your exposure. This system works extremely well under one condition. The same companies continue to outperform. As long as that remains true, concentration feels like strength, because the biggest positions are also the best performers, and that reinforces confidence. But there's a hidden trade-off. The system is not designed to reduce risk. It is designed to follow success, which means it naturally builds the most exposure where expectations are already the highest. And expectations, by definition, are fragile, because they depend on the future behaving a certain way. Think about it like this. If something is priced for perfection, it doesn't need to fail to disappoint. It just needs to be slightly less perfect than expected. That's enough. And when large portions of a portfolio are tied to those expectations, even small shifts can have outsized effects. Not because anything catastrophic happened, but because reality didn't match the assumption built into the price. Now, layer something else on top of this. Time. Not market time, personal time. Because the impact of all this depends heavily on where someone is in their financial life. If you're early in your investing journey, volatility is uncomfortable but manageable. You have years ahead, decades in some cases. Downturns become opportunities. Recovery has time to work. But as you move closer to needing that money, the equation changes. Risk isn't just about loss anymore. It's about timing. Because a downturn at the wrong moment doesn't just reduce your balance, it changes your trajectory. Let's walk through a simple scenario. Two individuals build portfolios over many years. They invest consistently. They earn similar long-term returns. On paper, their paths look almost identical, but the sequence of those returns is different. One experiences strong growth early, followed by a significant downturn later. The other goes through the downturn early, then benefits from growth afterward. Same average, same discipline, same strategy. Different outcomes. Because when losses occur near the point where money needs to be used, there's less time to recover. And recovery isn't just about the market bouncing back.
It's about whether your financial plan can withstand the delay. This is where concentration becomes more than just a technical detail. It becomes a risk amplifier. Because when a large portion of your portfolio depends on a small group of outcomes, the margin for error shrinks. If those outcomes deliver exactly as expected, everything works. If they don't, the impact is magnified. And if that happens at the wrong time, the consequences extend far beyond temporary losses. Now here's something that often surprises people. Most investors don't intentionally create this situation. They don't sit down and decide to concentrate their wealth in a handful of companies. They follow widely accepted strategies. They diversify across funds. They stay consistent. And over time, the structure evolves on its own. That's what makes it so difficult to spot. because nothing feels wrong while it's happening. Performance is strong, balances are growing, everything appears to be working, until the conditions change. There's another dynamic at play here, and it has nothing to do with math. It has to do with perception. When something performs well for a long time, it earns trust. Not just from investors, but from institutions, from analysts, from media. It becomes the standard, the benchmark, the example people point to when they talk about success. And once something reaches that status, it stops being questioned as much. Not because it's flawless, but because it feels proven. And that feeling is powerful. It reduces skepticism, it increases participation, it strengthens the very loop that created the concentration in the first place. But history shows that no asset, no company, no group of companies operates above economic reality forever. Cycles exist, not because something is broken, but because conditions change. Growth slows, competition increases, costs shift, expectations adjust. And when expectations are elevated, adjustments don't happen gradually, they reprice. At this point, it's important to clarify something. This isn't about predicting a crash. It's not about saying specific companies will fail. It's not about abandoning long-term investing. It's about understanding structure, because structure determines how everything plays out when conditions change. Right now, that structure is more concentrated than it has been in decades. Not because investors made extreme choices, but because the system gradually moved them there.
Up to this point, everything we've talked about lives in structure. How portfolios are built, how concentration forms, how risk quietly increases without being obvious. But structure alone doesn't create outcomes. It just defines the conditions under which outcomes happen. What actually matters now is pressure, because pressure is what tests structure. And right now, there are multiple sources of pressure building at the same time. Not in a dramatic headline-grabbing way, but in a slow, measurable way that compounds over time. The first source of pressure is valuation. Not the kind people casually mention, but the kind that determines how much future growth is already assumed in current prices. When assets trade at elevated levels, it means expectations are high. Not just for growth, but for consistency, for execution, for everything to go right. And the higher those expectations climb, the less room there is for anything to go wrong. Because prices don't just reflect what companies are doing today, they reflect what investors believe those companies will do tomorrow, and the next year, and the next decade. When expectations are low, good performance lifts prices. When expectations are high, even strong performance can fall short. That's the difference. It's not about whether companies are good, it's about whether they are good enough to justify what has already been priced in. Now, add a second layer. The cost of money. For a long period of time, borrowing was cheap, extremely cheap. That environment allowed growth to be valued very differently. Future potential mattered more than present reality, because the discount rate applied to those future earnings was low, which made distant profits seem more valuable today. But when the cost of money rises, that equation changes. Future earnings are worth less in present terms, which means valuations that depended heavily on long-term expectations come under pressure, not instantly, but steadily. This shift doesn't require anything to break, it just requires the environment to stay different. Higher costs, more scrutiny, greater emphasis on actual results instead of projected ones. And when that shift happens across an entire market, it doesn't affect all assets equally. It disproportionately affects the ones priced for the most optimistic scenarios. Now bring in the third layer, expectation versus delivery. Because there's a cycle that plays out in almost every major investment trend. At first, the story is uncertain. Only a few people pay attention. Then it gains traction. More capital flows in, more attention builds. Eventually, it becomes dominant, and at that point, something changes. The story stops being about possibility and starts being about proof. Markets are forward-looking. They price in what they expect to happen. But there comes a point where expectations need to be confirmed. Not discussed, not projected, proven. And that's where things become fragile. Because if reality meets expectations, prices stabilize. If reality exceeds expectations, prices can continue rising. But if reality falls short, even slightly, prices adjust.
And when expectations were extremely high to begin with, that adjustment can be significant. Right now, we're approaching that transition point, where narratives that have driven massive growth need to translate into measurable outcomes. Revenue, profitability, sustained demand. Not just potential, not just adoption curves, actual numbers. And the market has already priced in a lot of success, which means the margin for disappointment is small. Again, this doesn't mean failure, it doesn't mean collapse, it means sensitivity. Prices become more sensitive to results, more reactive to deviations,
more dependent on continued excellence. And when a large portion of the market is concentrated in assets operating under those conditions, the entire system inherits that sensitivity. Now combine all three: elevated expectations, a changed cost environment, and a transition from narrative to proof. Individually, each one matters. Together, they create a very specific type of pressure, the kind that doesn't necessarily cause immediate breakdowns, but tests stability over time. This is where historical perspective becomes useful, not because history repeats exactly, but because patterns echo. There have been periods where markets reached extraordinary levels of confidence, where dominant assets were seen as untouchable, where concentration increased because success reinforced itself. And in those periods, the turning point rarely came from a single event. It came from a shift, a gradual realization that the future wasn't going to unfold exactly as expected. There's an important distinction here. Markets don't need bad news to fall. They need reality to differ from expectations. That's enough. Because price is built on belief, and when belief adjusts, price follows. Now think about what this means in the context of a highly concentrated structure. If a large percentage of total market value is tied to a small group of outcomes, then the entire system becomes dependent on those outcomes being correct. Not partially correct, not eventually correct, correct within a time frame that justifies current pricing. Because if that doesn't happen, repricing isn't isolated, it spreads. This is why concentration matters so much more than people think. It's not just about owning fewer names, it's about how much influence those names have over the total result. Because when influence is high, impact is amplified, and amplification works both ways. There's another element that makes this even more important: time horizon mismatch. Large institutions can operate on long timelines. They can absorb drawdowns. They can wait for recovery, because their obligations are structured differently. Individual investors don't always have that luxury, especially those approaching the point where they need to rely on their portfolio. For them, time is not infinite, which means the ability to wait through extended recovery periods is limited. This creates a gap between how markets are structured and how individuals experience them. Because markets can recover over decades, but individuals need outcomes within specific windows, and when those windows don't align with recovery cycles, the results diverge. This is where preparation becomes everything. Not prediction, not timing, preparation. Because you don't need to know exactly what will happen, you need to be able to handle different outcomes. If things continue going well, you participate. If conditions change, you remain stable. If opportunities appear, you have the ability to act. Most people are positioned for only one outcome: continued growth. And that works until it doesn't. Because when everything is optimized for one scenario, any deviation becomes disruptive. The goal isn't to avoid risk entirely. That's not realistic. The goal is to distribute it intelligently, so that no single outcome determines everything, so that no single group of assets carries disproportionate weight, so that no single moment in time defines the entire result. Right now, many portfolios are more exposed than they appear, not because of poor decisions, but because of accumulated structure. Years of performance, years of passive allocation, years of reinforcement, all leading to a point where a small number of variables matter more than most people realize. In the final part, we're going to bring everything together, not in theory, but in action. What changes actually look like, how to adjust without overreacting, how to reduce exposure without abandoning growth.
At this point, everything comes down to one question. Not what the market will do, not which companies will win, but how your position behaves if things don't go exactly as expected. Because that's where outcomes are decided. Not during the run-up, but during the stress. Most people don't need a completely new strategy. They don't need complex instruments. They don't need to chase something different. What they need is clarity. Because once you see your portfolio clearly, the decisions become much simpler. Start with something basic. Open every investment account you have. Not just one, all of them. Retirement accounts, brokerage accounts, anything holding market exposure. And instead of looking at balances, look at holdings. Specifically, the top positions. Write them down, then combine them across all accounts. What you're trying to see is overlap, because overlap is where hidden concentration lives. If the same names keep appearing again and again, that's your signal. Not that those companies are bad, but that your exposure is heavier than you thought, and most importantly, heavier than you intended. Now quantify it. What percentage of your total investments is tied to those repeating positions? Not within a single fund, across everything, because that's your real exposure. Not what each product says individually, but what they create collectively. For many people, this number is higher than expected, and that's where the first adjustment comes in. Not selling everything, not reacting emotionally, just rebalancing with intention. Instead of letting the system decide where new money goes, you decide. Instead of adding more to what has already grown the most, you direct capital toward areas that have less representation. This doesn't mean abandoning strong assets, it means preventing them from dominating everything else. Think of it as redistribution, not rejection. You're not betting against success, you're reducing dependence on it continuing at the same pace. Next, look at your position from a different angle. Not just what you own, but what role each part plays. Because if everything is designed for growth, then everything is exposed to the same risk, and that's where vulnerability increases. This is where separating your structure becomes powerful. The first part is stability. Money that exists purely to remove pressure. Enough to cover your essential needs for a meaningful period of time. Not invested for growth, not exposed to volatility. Accessible, reliable. This isn't about maximizing returns, it's about eliminating forced decisions. Because when you're not under pressure, you make better choices. The second part is support. Assets that produce some form of ongoing output. Something that contributes without requiring you to sell. This layer doesn't need to be aggressive, it needs to be consistent, because its purpose is to reduce reliance on market timing. The third part is growth. This is where long-term investing continues, where you take risk, where you pursue returns, but now it's contained, balanced, aligned with your timeline. Instead of being your entire strategy, it becomes one component of a broader structure. Once you organize things this way, something changes. You stop thinking in terms of one outcome and start thinking in terms of resilience, because no single scenario defines everything anymore.
Now there's one more step, and this is where most people hesitate. Setting rules. Not complicated ones. Simple boundaries that guide decisions when emotions are high. Because the worst time to figure out what to do is when everything's already moving. For example, you might decide that no single position should exceed a certain percentage of your total exposure. If it does, you trim it. Not because it's failing, but because it's growing beyond your comfort level of concentration. Or you might define a condition where, if overall valuations reach extreme levels, you gradually shift a portion into more stable assets. Not all at once, not aggressively, just enough to create balance. These rules don't need to be perfect, they just need to exist. Because they create consistency, and consistency reduces emotional decision-making. Now let's bring this back to reality. Imagine someone who has been investing consistently for decades. They've built a solid portfolio, they've followed all the standard advice, and for the first time, they go through this process. They look inside, they measure their exposure, they recognize the concentration, not as a problem, but as a fact. They make a few adjustments, nothing extreme. They reduce overlap, they build a buffer, they create separation between stability and growth. They define a few simple rules, and then they continue. No panic, no dramatic shifts, just awareness. Now fast forward, the market enters a difficult period. Not necessarily a crash, but a stretch where expectations are challenged. Prices fluctuate, confidence drops, uncertainty increases. Most people react because they have to. Their structure doesn't give them options. They need liquidity. They need certainty. They need relief. And the only place they can get it is by selling. But the person who prepared, they don't face the same pressure. They have stability. They have flexibility. They have time. Which means they don't need to react immediately. They can observe. They can wait. And when opportunities appear, they can act from a position of strength instead of urgency. That's the difference. Not intelligence, not prediction, positioning. Because in every market cycle, there are two groups, those who are forced into decisions and those who have the freedom to choose. And over time, that difference compounds more than any single return ever could. The reality is simple. Most people believe they are diversified, but diversification isn't about how many names you own. It's about how your exposure is distributed. And right now, that distribution is more concentrated than it appears. That doesn't mean something bad is guaranteed to happen. It means if something does happen, the impact may be larger than expected. And the time to address that isn't during the event, it's before it. You don't need to overhaul everything. You don't need to predict the future. You don't need to outsmart the market. You just need to understand your position and make sure it aligns with your reality. Because at the end of the day, investing isn't just about growth, it's about outcomes. And outcomes are shaped long before the results show up. Take the time to look, not quickly, not casually, actually look. Because what you find there will tell you far more about your future than any prediction ever will. And once you see it clearly, you won't be relying on assumptions anymore. You'll be making decisions.